We broke the plumbing back then. Once it reopened, so it shut down, the markets didn't like it for the same reasons. The plumbing started creaking. The Fed had to come in, start going back from QT to QE, and also injected liquidity. So here we are. The shutdown's ended. It takes a while before the money starts flowing. So the TGA's only just kind of released $40 billion, but we're expecting like $200 billion or $250 billion over the next 2 months. So what happens then is eerily similar, should stabilize coming few days, next week, today, who the hell knows, doesn't really matter. I know it feels like it does, but it doesn't. And then the market took off like a rocket ship.
Hey guys, welcome to Everyday Finance. No one, not even Raoul Pal, anticipated the turn that the current crypto cycle has taken. The pattern was known for years. The banana zone. It's post-halving acceleration and a spike in global liquidity that sent Bitcoin into overdrive. However, Bitcoin is drifting sideways rather than taking off. There is no increase in liquidity. The pace has slowed. The US government shutdown, an abrupt $700 billion tightening in financial conditions, which subtly disrupted the cycle's timing, are the unexpected culprit in a macro shock that nearly no model could account for. According to Raoul, the cycle has been stretched and delayed rather than broken. His main argument, which is based on long-term liquidity mechanics, debt, and demographics, still indicates a huge upside. He now thinks that the real cycle peak will occur in 2026 rather than 2025. He contends that a 2-year runway driven by a liquidity expansion is mathematically inevitable. Rather than the typical 1-year post-halving peak, the only thing that has faltered is sentiment. The structural drivers remain unaltered. Many investors are wondering why nothing is happening if liquidity is the key. Raoul's response is straightforward. There was never a liquidity release. Everyone was keeping an eye on treasury activity, banking flows, and ETFs, but the shutdown stopped everything. The biggest driver of every cryptocurrency bull run flatlined. The anticipated liquidity wave never flooded into markets, and the Treasury General account remained trapped around $1 trillion. This explains why models seem broken, portfolios appear stagnant, and the cycle has seemed oddly muted. However, according to Raoul's analysis, this is the bull market, albeit one that is functioning on a lengthier and more vexing timeline. He anticipates that the cycle will violently accelerate again after the liquidity block eventually clears. The most explosive phase still ahead of us rather than behind. It's not a failure because of the delay. It's a buildup.
The Treaty of Versailles, after World War I, basically forced the Germans to pay reparations to the French. That caused the Germans to essentially go bankrupt and have to hyperinflate. That broke German society and caused the rising of the Nazis. That led to World War II. World War II, the end of it, led to a baby boom from world peace. Baby boom was the largest demographic boom of all time. That baby boom has basically driven the global economy ever since. The inflation of the 70s was not a monetary phenomena. It was actually driven by demographics. It was driven by the baby boom cohort coming into the workforce all at the same time, demanding goods. And there wasn't enough supply for those goods, so the world had to adapt. Then we had obviously the Suez Crisis and a bunch of other things that came onto it, and a bunch of money printing and other stuff that happened, but and then leaving of the gold standard, all of this stuff. But really, it's a demographics issue. As they've aged out, they've also driven everything from investment markets, index funds, pension market. Everything has been driven by this cohort. So this cohort is now retiring. It's leaving the labor force. As it leaves the labor force, we can project out into the future because of the births, deaths. What happens to the labor force participation rate? This is happening everywhere. It's falling over time. So as it falls over time, and forecastably so, we increase the debt to goose growth, because growth is driven by population growth, productivity growth, and debt growth. Debt growth is this part that I'm showing you, is to offset the slowing of the population growth and that decrease in the labor force participation rate. Less people being productive in the labor force, old people are less productive, and that leads to slower growth. So the government increases debt to offset it. That debt is financed by liquidity. This measure here is the Fed net liquidity, but actually in recent years, it's moved to US total liquidity and global liquidity for the global debt cycle. What's the difference between Fed net liquidity, global liquidity? Fed net liquidity is the Federal Reserve balance sheet plus the Treasury General account and the reverse repo that's now been drained and probably will never get rebuilt. But they've moved the liquidity onto the banks now, which is what our total liquidity measure takes into account, that plus M2 growth as well. Anyway, it doesn't really matter. Liquidity is the basis of money to pay the debt driven by the demographics. Okay, that's the game. That's the whole game. Understand that, and you understand everything that comes after it. Then we've created this cyclicality. We had a perfect 4-year ISM cycle that changed, and it's driven, the cyclicality of the economy is driven by the debt maturity distribution. So the debts have to be rolled, and we need to, because going back to this chart, if you remember, we pay it by debasing currency. And so when the debts get rolled, currency debasement increases. And that is the process by which markets and economies have operated since. It's all the same cycle, and it happens globally. So up until 2024, we had this perfect 4-year cycle. I mean, perfect. And that was because the debt maturity of the debts after 2008 was 4 years. And then something changed. And we're like, what the fuck is going on here? We didn't really understand it until we went back to this and redid the maths and realized in 2022 and 21, when rates went back to zero, they extended the maturity of the debt from 4 years to 5 years, or 5 and a bit years. And so what that did was break this. We had this extra year in the middle that we never had before. The extra year in the middle didn't need peak refinancing. The refinancing is for this coming 12 months. So we haven't had peak refinancing. So you didn't get peak economic growth. Economic growth was held because we didn't get that stimulus. Rates remained higher because of it. And the cycle extended to this. And this is the 5.4 year sine wave. Now, we don't know what the next cycle is going to be, depending where all the debt maturity ends up. They're all sticking it in the short end right now. It might shorten it back down to 4 years. Don't know. We'll have to see, but this is what we're dealing with. And where we should end up is peak cycle is somewhere towards the end of 2026. This is the reason we don't believe in the 4-year Bitcoin cycle that's suddenly independent of the NASDAQ. They're all the same cycle. Or the ISM, it's all the same cycle. But suddenly some people online, it's like, well, it's all over now. We didn't get our rally in November and October. It's finished, all over. Let's come back again in 18 months' time.
Raoul's first point clarifies the true driving force behind the cryptocurrency cycle, which isn't the popular narratives of ETF inflows, supply shocks that cut in half, or Fed pivots. It is the more profound structural factors, such as the rolling schedule of refinances, debt loads, liquidity flows, and demographics. Despite declining rates and ostensibly positive liquidity, many investors are perplexed by Bitcoin's sideways movement because the market feels random without an understanding of that machinery. The explanation offered by Raoul is simple. The cycle itself changed. Corporations extended their debt maturities by an additional year. When interest rates fell to zero in 2020 to 2021, resulting in a missing middle year in 2024 that had never occurred in prior cycles. Instead of ending the cycle, that one distortion extended it by pushing the liquidity and stimulus timeline forward. In reality, everyone's confusion and impatience are confirmation of this delay. Raoul contends that the real peak occurs in late 2026, rather than in 2025, a date that is backed by all of the main structural factors, including demographic shifts, interest burdens, rollover schedules, liquidity, dynamics, and even the behavior of gold. They all point to the same extended apex, which created the blind spot that initially upset the liquidity model.
US government shutdown. This is where we got it wrong because it wasn't something we could know. And there's one bit we missed that we didn't really fully grok at the time. And that was the fact that once the reverse repo had been drained, which was a net stimulus, net liquidity boost, the rebuild of the Treasury General account, they build this bank account up and down. So it doesn't really matter. But when you've got no offset to it, and the Fed is doing QT, that was a 700 billion tightening in financial conditions since July. It was dramatic, and there's no offset. See, in 2023, when it happened, they were draining the reverse repo, and it offset it. But this one didn't have that. And so we didn't really see that. And that was what caused that global M2 chart that like people just don't understand, because I said it's not going to work all the time. But why didn't it start? Why did it break apart? Well, it broke apart very simply because liquidity got sucked out of the system, and it got sucked out of the most beta to liquidity asset in the world is crypto. So it came out of crypto. And if you think of the crypto beta curve, you got Bitcoin and then Solana, let's say, and then let's say SUI. They're all different levels of beta or leverage to this trade. And what happened is liquidity starts coming out over this period. Now, the TGA should have been started draining two months ago. And once they drain it, it starts lifting asset prices significantly, the normal cycle. What happened this time is they shut down the government. So they couldn't drain it. So it got stuck at $1 trillion. And normally you drain it, but they didn't. So normally we would have seen something like 2022 where we start to see a drain. We didn't get that because it got stuck, because they stopped spending money. So therefore, no liquidity in the system. Therefore, stuff like M2 doesn't flow through the system and things fall apart. Now, NASDAQ didn't, because 80% of all asset managers had underperformed the benchmarks this year because none of them had technology, and they still don't. There's still a record number who think AI is a bubble and therefore they're underexposed. So the more tech goes up, the more they have to buy into year end. And that dynamic's always very interesting. It's called performance or benchmark chasing. Added to the fact there's a load of buybacks in that sector as well. Very hard to fade. Very hard to fade unless liquidity is fully, totally turned and rates are going up and all that kind of stuff, which is not happening. The other thing is, if we think about the crypto market outside of Bitcoin, you'll notice that none of these things have gone to new highs, really. I mean, Ethereum, Solana, none of this has. Why? Because it's driven by liquidity. US total liquidity has not gone to new highs yet, but it will over time because, again, to keep explaining this to you guys, because you don't want to hear me, and you lose impatience, and you go, why didn't it go up? Is we've got to do this game. We've got to pay for the interest on the debt. The only way of doing it is global liquidity, or is total liquidity. And as you go through, that then lifts that. So if you go back to that chart, there's the hockey stick over time, that longer term version of the banana zone that has to come into play, because if not, the whole system falls apart. So there you go. Now, the last time it shut down was back in 2019. Again, we kind of broke the plumbing of the financial system back then. So good. We broke the plumbing back then. Once it reopened, so it shut down, the markets didn't like it for the same reasons. The plumbing started creaking. The Fed had to come in, start going back from QT to QE, and also injected liquidity. So here we are. The shutdown's ended. It takes a while before the money starts flowing. So the TGA's only just kind of released $40 billion, but we're expecting like $200 billion or $250 billion over the next 2 months. So what happens then is eerily similar, should stabilize coming few days, next week, today, who the hell knows, doesn't really matter. I know it feels like it does, but it doesn't. And then the market took off like a rocket ship.
Raoul Pal is improving his thesis rather than reversing it. He now believes that the government shutdown, which halted spending, stalled the TGA drain. And choked liquidity did not kill the bull market. Rather, it merely moved forward. Instead of ending the cycle, that disruption postponed the ignition and created subsurface pressure that will eventually explode when liquidity flows resume. Raoul frequently cites 2026 as the actual cycle peaked because of the convergence of structural forces, debt rollover schedules, and liquidity calculations rather than shock value. His point is that when the door finally opens, Bitcoin usually moves first and fastest because macro cycles don't react to frustration. Debt still needs to roll and liquidity needs to increase. We are experiencing the flat, quiet, discouraging phase that comes before acceleration, not failure. However, Punk 6529 issues a warning that strikes at the heart of the industry before celebrating the next leg higher. The market feels bored, hollow, and unfocused, rather than capitulated. There are no longer any narratives. Spark has vanished. And he contends that this is because cryptocurrency has strayed from its roots and is now pursuing institutional acceptance rather than decentralization. He draws attention to the fact that more Bitcoin than ever is currently held in custodial accounts, particularly Coinbase, none of which are impervious to interference from nation-states. If the ETF era promotes a future in which institutions, rather than individuals, own the majority of Bitcoin, it could be both convenient and risky. Punk presents the dilemma in a straightforward manner. A world in which BlackRock successfully manages the supply is a courteous failure, whereas the true goal is for billions to have self-custody. The window for true permissionless ownership may be closing as regulators look into tightening controls over custodial service providers. This compels investors to ask themselves a more profound question. What future are they genuinely helping to create? Because if Bitcoin loses the qualities that made it revolutionary, price targets and liquidity cycles are meaningless. Zooming out from your own principles as well as the charts is necessary at this moment. Which would you prefer? A decentralized tool that no government can take away or stop, or a popular macro asset? Punk 6529 is working to address that issue. And before the next stage of the cycle begins, every serious investor needs to have an answer.